So, as Daphne said, I'm going to be talking about mandatory human capital reporting. And I'm going to start by talking about what it looks like without mandatory human capital reporting. Right now, the SEC is considering a move to make mandatory some sort of disclosure having to do with the workforce. Exactly what that is, I'll talk about later. This is going to have a huge effect on the people analytics profession. For people in publicly traded firms, it's going to obviously have a huge effect because the people analytics function is going to be the group that has to write the reports and compute the metrics that are eventually going to be disclosed. Eventually, investors are going to start reacting to those metrics. And when they react to those metrics, you're going to be asked to do things, you and the HR function generally are going to be asked to do things that will make the metrics look better, whatever that means. And of course, that's a big question. This will affect the way HR is run and what people analytics does and the impact that it has. Even people in privately held companies are going to find it makes a difference because private equity has been more and more interested in some of these issues, and the requirements for public companies are a natural place to look. So let's talk about what happens now without the metrics. Right now, securities law disclosure is tightly tied to accounting. It pretty much all has its origin in accounting principles. The accounting, therefore, has a covert influence on how people analytics is practiced. Even without any explicit disclosure, there are some feedback loops. Let's go over how those work. The fundamental issue is that accounting overlooks human capital. So on the one hand, you have people costs on the left-hand side. On the right-hand side, we have human capital, because the money that a firm spends on short-term people costs, compensation, benefits, training, all those things go one way or another to building human capital in various forms. They build skills, which are worth something to the company. They build loyalty and engagement, we hope. They build firm-specific knowledge of how the firm practices and what's necessary to work there. Accounting counts people costs. All those things go down as a cost, but none of the things that go into human capital are reflected in any way in accounting measures. This is an enormous gap that has significant consequences to the way that human capital is managed. So what are the pitfalls of it? One, I'm going to start with an extreme example, layoffs. I realize that's a small part of human capital management, but it's one that illustrates the problem very clearly. So let's suppose, for the sake of argument, that we can easily value, which we can't, the costs and the benefits of a layoff. And let's say we're going to gain $10 million or we're going to save $10 million in costs. By laying people off, that's $10 million in compensation we don't have to pay, training we're not paying for, and so forth. From an accounting point of view, that's the end of the story. So we're ignoring human capital, and the layoff looks profitable. However, that's misleading. Let's say, and again, this is a made-up number, but let's say that you're losing $30 million in terms of training you invested in, loyalty you invested in. This has very, very real consequences, because when the time comes, you may need to rehire people. You're going to have to spend that money again retraining them, building loyalty, and teaching them about your company. So that $30 million is a real loss. So if you've had a layoff in order to increase your quarterly earnings, that's a real cost that's going to come back, that can come back to haunt you. And if you considered, again, with these hypothetical numbers, what the real cost of a layoff was, it would be clearly unprofitable in this case. But the accounting profession doesn't reflect this. So from an accounting point of view, all that shows up is the $10 that you save, the $10 million that you saved. A corollary of this is that stock prices don't reflect human capital. So you frequently see headlines, massive layoffs, stock price goes up. This is a common scenario, and there's a lot of evidence to support it. So this is clearly an undesirable situation, clearly only from the point of view of stockholders. Right now, I'm not asking you to think of anything other than stockholders. The stock market is reacting irrationally from the point of view of shareholders to the layoff because it's not considering the benefits, the human capital that's being lost in addition to the costs that are being saved. So this has a lot of implications for human capital management. It encourages very short-term thinking about human capital management. There's a sort of term, churn and burn, which basically means a short-term oriented human capital strategy. So one of the subtler points, but one that's I think really critical, and I'm going to keep coming back to it, is hiring the applicant with the highest degree. Credentialism. How many people have heard about credentialism or talk about it in their own work? Right? It's a serious problem, right? And it's one that's growing significantly over time. There's a lot of evidence that when you look at a workforce, the ads that are placed for new hires have grossly inflated credentials compared with the people who are incumbent. So there's one study that showed 15% of production managers have a BA, 65% of ads for production managers require a BA. There's something seriously wrong. As I'll get to a little bit later, this is sort of a trend that's gotten worse over time for various reasons that fairly clearly have to do with stock market dynamics. So you've first got credentialism. Now, why is this driven so much by the account? Why does the accounting distort this? Because overqualified people are easier to train. So that sounds good. Why would you not hire them if they're easier to train and you can get them? Because they leave faster. But leaving faster is something that doesn't show up in accounting numbers. Again, it's one of those asset costs. It's sort of a subtle version of the layoff problem. You're losing them, but the loss never shows up. So you've saved on training costs, but which are visible, but what it's costing you is human capital accumulation. Sacrificing the future in order to save current costs. Another thing that this causes is paying the lowest possible wage. Now, I have nothing ethically against paying, well, I won't say that. There's certainly a case that businesses shouldn't overpay. So let's just think about this from a purely self-interested point of view of the business. Why shouldn't you pay the lowest possible wage? Because it's not a way to build loyalty. If you pay somebody the lowest possible wage, they're also going to leave the minute they get a better offer. So again, it's a short-term strategy. If you pay the lowest possible wage, you're, again, saving costs that are visible to accounting and to the stock market, but that are, in the long run, going to cost. Another issue is don't train. Training costs money. Again, a visible cost, an invisible benefit. And then the final corollary of this strategy is fire freely and tolerate quits. All of this cycle only works because you've got a short-term horizon. You're not worrying about layoffs. You're not worrying about people quitting voluntarily. You are focusing on costs that show up immediately. By the way, I know we're not close, but I noticed there's no clock in this room, and I don't want to go. Is anybody, pardon? I know I've got a lot of time, but I don't want to get behind. Is there a What time should I aim for, and what is the?
12:10 is lunch, so you got about 17 minutes.
Okay. So we're going to close on time, more or less. All right. So an alternative strategy is the long-term strategy. The long-term strategy is the employment quality strategy. The employment quality strategy hires skills, not credentials. In other words, it's a lot harder. You have to dig deeper into the resume. You need to think about what the skills for the job is, what for the jobs required, and what the person has. It requires a lot more investment in the talent acquisition process. It's expensive. It also may require you to hire people who aren't trainable as quickly as somebody overqualified. But it does have a long-term payoff. You get a better match, you get somebody who's happy with the job they have, and you gain an employment stability. You compensate to build loyalty. You train for internal mobility. You assume that you're better off with promoting from within because these are people you know. You're in a position to gauge their effectiveness. We've all hired people who look great, and after a few months, it's clear they're not such a great fit. They're worth keeping, but maybe not worth promoting. And ultimately, if you've got your internal pipeline, you've got much better information on the people who you're moving upward in the organization. So you're creating these career ladders that are promoting the right people, building loyalty, and reducing turnover. So far, I've only mentioned from a purely shareholder point of view, an investor point of view. But obviously, there is a human cost. Credentialism and degree inflation affect real people. Here's one of the many articles on this. Here's Landon Kreider, who has a BA from a good school, very good school, Georgia State, and he's working as a courier. This is bad not only for him, but it's bad for the high school graduate who should have had that job. So where did this all come from? Well, corporate governance is the principles by which we make business, the corporation makes business decisions. The shareholder primacy model is the idea that shareholders are the main or sometimes even sole focus of the purpose of the corporation. For a long time, shareholders were considered extremely important, but not necessarily the exclusive stakeholder in a corporation. They were, in 1990, in the 80s, the Business Roundtable released a statement on the goals of the corporation in which it said the shareholder interests have to be balanced against the legitimate interests of other constituencies. So shareholder dominance, but not shareholder exclusivity. Something happened during the late 80s. It was the hostile takeover rage. What this did is hostile takeovers made managers terrified about keeping their jobs. As a result, they became extremely focused on quarterly earnings. This gave them a shorter term focus, and it shifted to a model of corporate governance known as that was a much purer form of the shareholder primacy model. And in 1997, the Business Roundtable, the Oracle of Business, announced that the duty of management is to shareholders, period. So it had switched to a pure shareholder primacy model. Now, some of you have probably heard in the last year, the Business Roundtable has done a reversal. It's basically said, no, we have a commitment to all our shareholders. And it very explicitly tied this to the fact that it was concerned about the fact that the American dream was fading, and it was aware that it was failing its responsibilities to employees. So this new, broader stakeholder approach is sometimes referred to as part of an environmental and social and governance perspective, or ESG perspective, which is what I'll refer to it as. As a result of this, the growing interest in ESG a lot of investors have expressed their concern and their desire for greater human capital disclosure. In addition, it's also becoming clear to them, to investors that is, that it's not in their interest not to know about human capital. This was the material I started with, that even from a purely shareholder point of view, the ignoring human capital is distorting business decisions. So the SEC is announced its intention to issue, it's begun the process and is fairly far along the process of issuing final regulations which will require human capital disclosure. Is this good or bad? Well, on the one hand, it's an opportunity, because if we have well-chosen metrics that have to be disclosed, it will bring investor attention to human capital issues, and it will be a counterweight to the missing asset valuation, because firms will be able to make the case that what are apparently costly decisions, like retaining employees in bad times, are in fact justified because they can point to another metric. Now, in principle, of course, they could say that verbally now, but we all know that focal effect that having a number has on people. It has a magical effect if you can point to a number. So if we have the right metrics, management will be able to point to these metrics and say, okay, you got to balance these two things against each other. It could be a headache, though, because if we have poorly chosen metrics and we draw attention to the wrong things, there's the potential for distorting behavior. So what does the proposed SEC rule look like? You're probably shocked at it. As we look at it, I'm sure you expected me to provide you with a list of things which they're going to require people to disclose, in companies to disclose. The central provision is, at least of the proposed regulation, but I don't think it's likely to change very much. The central provision will be a requirement that firms provide a description of their human capital resources. So is it going to get any more specific than that? Well, it may say, it's probably, and again, this is from the proposed version, it may say it has to disclose any human capital measures that management focuses on in managing the business. Again, a little less clarity than one might have expected. The final likely part of the regulation is a little more specific. It says measures that address the attraction, development, and retention of personnel. Okay, a little more specific, not a lot. So if this is probably what the reg will say, and it might have a little more content than that, we don't know. But this is the general trend of the SEC's rulemaking across all issues. I think we're going to end up with a very open standard. So, now I am running out of time. So we have some potential, what are the potentially distortionary metrics? There are a whole bunch of, what's going to happen is the SEC and investors are going to start looking to existing bodies of metrics to learn from. And those are, it's going to draw on those in some degree or another of with some degree or another of informality and incorporate them. The existing metrics that are important are, first, the ISO standards. These are by far the best of the bunch because they're the most modest and true to their purpose. They don't pretend to do much more than simply say, let's get the ball rolling, measuring some important things, and they do that. The other ones are almost all ESG standards. They're put out by SASB, I'm not going to go through the whole list, you may or may not know them, SASB, B Corp, Just Capital. These, however, are the ones that are more ambitious because they purport to measure big normative things like, are you a good employer? And they do so in ways that have the potential for tremendous distortion. They all focus very, very strongly on entry-level wages. Now, entry-level wages are important. We all care about what the least fortunate make. But measuring a measurement system that focuses entirely on them is going to backfire. think about what happens if all you look at is the entry-level wage. Suppose you're a company that is hiring people at, not the highest entry-level wage, but one that's a starting point, and you're promoting them fairly quickly. All of a sudden, you've got a huge amount of pressure to raise that entry-level wage because that's the only thing anyone looks at. You're going to raise that entry-level wage, but you're not going to raise anything else. So at most, you're helping a few people at the bottom because that's your sole focus. But in order to do that, there may be a lot of unintended consequences. There's an incentive to shift away from benefits towards wages. I think you all know an extremely large company that did that recently, raised the entry-level wage, and there were reports the next day about how it had eliminated most benefits for entry-level workers. There's a huge incentive not to hire risky workers, because if you're having to pay more money for them, then why not go back to credentialism? Why take a risk on a high school dropout who has an unstable employment history? So huge consequences. Now, this could be solved if we have better metrics, but none of these metrics that would help are in any of the current systems. So just to outline, some of the things that would help is if we looked a little bit not just at legally protected diversity categories, but we looked at things like socioeconomic categories, like how many people without high school degrees or with just high school are you hiring? That's something completely missing from the existing systems. There's very little in the existing systems on internal mobility. Metrics that focused on those issues would provide a powerful counterweight to the focus on the entry-level wage alone. With that in mind, we've started the Employment Quality Metrics Initiative. Our goal is to describe employment quality. That is, it's not a comprehensive effort the way ISO is. We are focusing on employment quality from the point of view of both shareholders and employees. And again, with the greatest respect for ISO, which I have had at least not as deep an involvement as Jeff has, but somewhat of an involvement, and which I have great respect for, it's a very different, more organic, less formal system. And the final difference is it's drawing entirely on the people analytics community. That ISO and other systems, including SASB and the other ones, have drawn on accountants, they've drawn on ESG people, they've drawn on people who, parts of the parts of the HR function who aren't analytics people. But relatively few, Jeff is an exception, relatively few people analytics people have been involved. Our idea here is, may I run a couple of minutes over? Or if you want me to stop on time, I'm gonna hurry up. Do you want me to stop? May I have 5 minutes over because we started late? Is that okay? So with high-level metrics, our goal is to start first with the primary data problems, of which there are a few. Quite a few. We're then going to work up to foundational metrics, which are taking the existing metrics that we have, such as turnover, and adapting them to the cause of measuring employment quality. And then ultimately trying more ambitious things like, can we measure things like economic opportunity? The key mechanism for this is an employer working group. The firms in the employer working group who are listed on the bottom are all committed to beta testing the metrics on their own data, to coming to a few in-person meetings, and then to attending remote meetings. In addition, after we finish that process, we're going to move along from the employer working group. We're going to get the input from providers. We've got an advisor. We're putting together an advisory board of the people analytics community. We're going to disseminate it more broadly in the people analytics community, and then we're going to bring in investors. So in order to give you a few minutes for questions, I'm going to conclude quickly. I hope some of you will be interested in getting involved. If you are, you can contact me. You can contact Daphne, who's back there, and we have a website. So I'm going to leave just a few more minutes for questions. Any questions on any aspect of this, on what the SEC mandatory disclosure rules will look like, where the problems in them are, how you can get involved?
Are you allowing, so this is not necessarily a new concept in Europe. Europe's been doing this for, I mean, some companies have been doing it for the last 15, 20 years. Deutsche Bank, for example, has an annual human capital report that they produce along with their financial reports. That report generally is very strategic in nature. They will generally talk about their business strategy and critical talent segments that they're developing. They'll look at social justice issues, diversity, female diversity in their case, and they've done over the last 5 years. I feel like some of the metrics here feel fairly tactical. What are you all looking at Europe and kind of how they inform analysts with really strategic human capital management and how they are making human capital investments that directly tie to business strategy and how they manage key talent segments?
We're trying our best to do that, and if you have another source we should look at, GRI is the, I think, more European focused, and it does have the failing that I outlined. It is primarily focused on entry level. I don't have it in front of me, but all of the ones I mentioned do have this blindness about mobility. None of them look at mobility. None of them look at socioeconomic issues. So as far as I know, if there's a European source I should look at, I'd be thrilled if you could give me a reference.
On the prior question, do you think there's going to be things related with diversity or like pay equity and even just, mobility, et cetera, and proportions of, male, female ethnicities, et cetera?
Yeah, we've actually divided it into 4 subgroups. Mobility is the one we're starting with because we think it's, in many ways, I think it's where the biggest problems are, the biggest gaps in other ones. We're also going to look at employment quality, which will include work-life balance, engagement, things like that, diversity, and economic stability, which is intended to look at the issue of a floor in a more flexible, less rigid way than just looking at what the lowest level employee is being paid. So I focused, for reasons of time, I focused on what I think is the worst problem, but it's not going to be our only focus by any means.
So in terms of kind of standardizing the benefits part of it, so pay is probably one of the easier ones to look at, but when we start looking at benefits, it gets really tough because what do you offer, what a company offers for whatever, any kind of different outlook on.
Well, that is one of the things we're trying. I'm going to answer it by simply saying we recognize that it's a serious issue, and I think it's one of the big problems with the current. The reason we end up with this distortion is because all those standards look at the wage only. They don't look at total compensation. So one of our goals is to look at total compensation, but we recognize that raises terribly complex issues. So, again, we're just starting out, and if you have thoughts on how we should do it, I would love input. You don't have to give it to me right this second, but yes, it's a big problem. And dealing with the data problems, they're both conceptual and data. So the conceptual issues are, do you count a benefit that somebody doesn't use? If somebody isn't using their educational benefit, does that count as part of their compensation? There's no simple answer to that. Then there are data problems. So, yes. There's a reason people have gone for the simple metrics, and we don't mean to be, we don't mean to say, oh, these stupid people, how could they have done that? They did it because you have to start somewhere, and this is the straightforward place to start. But once these become, and as long as we were dealing with voluntary reporting, I don't think they were as distortionary. When you start turning it into a mandatory, systematic, I think the potential for distortion is going to get a lot larger.
Quickly, so if the SEC is going to be the ones, or at least in the United States, regulating that, how is that sort of influence going to be from all these groups, including this one group you're talking about, to pass that message and that work, you try to understand, is there going to be the power to influence them in that decision?
That's a very difficult question, and all I can say is the way U.S. law works, and I can't speak for other countries, is there's a long tradition of incorporating standards that are generated by private bodies into U.S. law. So, just for example, as GAAP is generally accepted accounting principles are part of the financial part of securities law, some of this is going to be absorbed. How that happens is complicated. I think a lot will depend on investors. And so we're going to try to get investor buy-in on this because we think that's very important.
On that point, a lot of work has been done, by a number of the finance professors and community, and accounting community, because they understand that looking at just the accounts doesn't really give you a great picture to understand the future success of the company. So I'm thinking of balanced scorecard and other such more rounded approaches to it. Are you incorporating some of these things? Because those are precedents that investors will look at, remember, and may make it easier for you to convince them that this is the way forward.
See, the nice thing about mandatory disclosure is we don't have to convince them anymore. I mean, there was always a problem in the past of having to disclose them. Now the question is not whether they're going to disclose, it's what they're going to disclose. And I think very few companies are going to want to say, oh, I just want to disclose the entry-level wage, because that very seldom makes them look good, right? So I actually think, and as I say, as you saw from the list, we have a lot of major corporations who are interested in this. We would like more if anybody is willing to make it. It's a significant commitment at this point, but if anybody's interested in joining, we're still open to members, and later as we get further down the pipeline, there'll be room for input with less. But I'm not, that's the least, as I say, that would have been a problem before the SEC got involved. Now I'm not worried about it. I'm worried about getting the right standards, but not necessarily that people have to be convinced that we need them. All right, any other questions? That is a very good question. The SEC is hard to predict. I would guess a year, Jeff. I'm going to guess no more than a year. And we had originally hoped to have some influence on the process, but I think it's too late for that. And I think the best we're going to do is the common law, and then hopefully, eventually, the SEC will consider if a consensus emerges. Maybe the SEC can always issue new regulations. It's easier to do that than it is to. So I think what we need to view this as an iterative process. We get a very general standard out first, then hopefully a practice develops, and then maybe that becomes more consolidated. All right, I never stand between an audience and lunch, so thank you very much.